All right. Today is Wednesday, March 16th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's dive right into it. In focus. How about we go over the verbal diarrhea from Jerome Powell today? But before we do that, let's go over the events and how the day unfolded. Because in the morning, right away, the Hong Kong Stock Exchange, the Hang Seng, was blasting higher, to the tune of over 9% gains. Matter of fact, right off the bat, all of these wounded Chinese stocks, Alibaba, JD, NIO, were blasting significantly higher in the pre-market. And of course, yours truly was talking about buying Alibaba calls yesterday. I was looking at them. I was considering buying calls for Alibaba, but you can't win them all. Missed on that one. No steaks and lobster for me, at least this week. But the week is still young, and we have a lot of opportunities to talk about. But as the day was shaping in the morning, right off the gate, we had some good news from China, and that propped up equities higher. Not just the Chinese equities. On top of that, more good news, this time around from Ukraine. Of course, Zelensky talked to the US Congress today, but he's also been, or getting, a little more realistic, as he described it, by the way, in terms of the negotiation with Moscow. We know about the four conditions by Russia: the ceasefire, no NATO, handing over Crimea, and the two other regions that are contested right now. My hunch is the Ukrainians are becoming more pragmatic about the negotiations, meaning they're willing to accept the majority of these terms. Matter of fact, Zelensky came out yesterday and said, no NATO. We already know that. We're not going to have NATO in Ukraine. But the sticky issue remains, number one, our side, the US, the warmongers that we are. We've been jerking off to this war for a long time. And this is fantasy, becomes reality. So we're going to keep pushing this guy. We're going to give you weapons. Keep fighting, please. Keep fighting. But at what point does rationality takes over? But besides that, point number two, the problem with these negotiations is the contested two regions that Russia is asking for to be independent from Ukraine, or autonomous regions. Ukraine is not going to give that up easily. This is the sticky point for now. And as I've been telling you in this program, there is an economic aspect to this war. For example, we talked about the issue of oil and gas and the pipelines numerous times in many videos in this program. But what about grains, specifically wheat? As you can see, Ukraine is rich with grains. It is the breadbasket of Europe. And so it happens in northern Ukraine, we see a lot of production of corn. Likewise, the production of soy is also concentrated in the northern side of the country. In the southern side of the country, however, we see wheat production being predominant. Likewise, the majority of sunflower production happens in the southern part of Ukraine, which, by the way, happens to be the majority of the areas that the Russians are occupying right now. They're occupying the south, they're struggling in the east and the north. But these two specific areas that the Russians are asking for happen to be critically important from an economic perspective. Why? Look at the mineral concentration in Ukraine. It happens to be in these two regions, Donetsk and Luhansk, the two regions that the Russians are asking for to be carved out of Ukraine. So again, there is an economic aspect to this conflict. Nobody's talking about it. The good news is we're getting closer and closer to a peace deal. It appears, at least at the moment. The problem is, the longer we wait and we push the Ukrainians to continue to fight, it's a losing fight. Sooner or later, they're going to start losing cities, major cities, and this will play in the hands of Putin. He's going to have more cards to play with. You want this back? You got to give me this. So the longer we wait, we give Putin the leverage in this war. So hopefully that cooler heads will prevail and we will have a peace agreement soon. So far, the day started positive with good news out of China and good news out of Ukraine. And then came the bad news out of Japan. An earthquake right by Fukushima. No big deal for now, we're just going to shake it off. But perhaps the most anticipated event of the day was the press conference by Jerome Powell. We already knew that the Fed was set to raise interest rates by 25 basis points. But the most anticipated part was Jerome Powell's press conference. His tone. Will he be dovish? Will he be hawkish? Owlish? Eaglish, whatever animal you want to throw in there. But if you've been watching the videos I've been producing the last few days, specifically the options market coverage, you knew ahead of time the market already made up its mind. The market wanted to go higher. We've witnessed call options buying in the queues, on chips, on software, on big cap technology stocks. On the other hand, put options buying on the recent winners, specifically oil and gas. So we go back to the cash that has been raised by profit taking from the oil, palladium, wheat, the Russia-Ukraine trade. Did that cash go into buying the dip in technology and the high multiple names, and this is the trade that we have to follow? Hold your horses, we'll talk about that in a second, but let's cover the press conference by Powell, and the most important headline is Jerome Powell, this is at least the take for now. He signaled the willingness to sacrifice growth to stop inflation. And I say, what growth, Mr. Powell? Whatever left of growth right now, growth is already going down. In other words, Jerome Powell is willing to be aggressive, at least according to this today, even if that means crushing growth and demand in the economy. And the goal is to stop inflation. This is the Volcker-like approach. At least these are the words, not the actions. Now, we talked in details in yesterday's video. If you're going to increase interest rates dramatically to combat inflation while growth is already deaccelerating in the economy, hence stagflation, we're gonna dip into a recession. So in other words, Powell pretty much said, I'm willing to go to a recession if that's what it takes to beat inflation. This is at least from the FOMC minutes. We haven't heard the man yet, so this was scary. This was too hawkish. On top of that, according to the minutes, it appears that Jerome Powell and the Fed, this is the consensus for now, they see 7 interest rate hikes this year alone. Today was 1, and we have 6 more ahead. Now, remember what Mohamed El-Arian said, if we have 7 interest rate hikes, as the market is pricing right now, then we will head into a recession 100%. So all of this is scary. All of this is hawkish, and right away you saw the Dow Jones losing about 500 points worth of gains and dipping back in the red. And then came the man, and he opened his hole, whatever that is, and started puking all over the place. And the market liked it, and we saw the massive rebound by the end of the day. So what did Jerome Powell say to rescue the stock market from the drop? I'm not going to play the clips because I'm sick of this guy. I cannot even stand to listen to him anymore, and his lizard mouth, and all the garbage and the propaganda and the bullshit that comes out of that thing. But luckily for us, CNBC has these banners where they quote Powell, and I think these will do the job properly. So here it is, a segment we call Laugh with Jerome Powell. Powell says the economy is very strong. Oh, really? And then he says this is still the strong economy, right? He says inflation remains well above goal. Duh. Powell adds inflation to take longer than expected to return to goal. Oh, you think? He continues to say that the Fed will take steps to ensure high inflation doesn't become entrenched. Mr. Powell, it is already entrenched. This is all, you're still behind the curve. This is like seeing a child drowning in the pool and saying, hey, hold on for a second, I gotta finish my margarita. So far, Powell been saying the economy is strong, inflation got a little out of control, but we're gonna do something so it's not entrenched in the economy. Okay, this is like watching a psychopath because he starts to minimize things and then admits that they're bad. Then he moves on to say, oh, it's not my fault. So is it not a big deal, or is it a big deal, and whose fault it is? Powell says he's acutely aware of the need to return to price stability. So what are you going to do about it, Jerome Powell? How about going back to transitory? Yep, the man cannot help himself at all. He went back to transitory again. And he said that part of the near-term inflation drop will be due to supply chain fixes. Again, blaming inflation and supply chain, not the reckless cocaine policy from the Fed. What about that supply chain, by the way? He just said that in the near term, supply chain fixes will drop inflation. And then he says, but supply disruptions are larger and longer lasting than expected. So which one is it, pal? Is it long lasting or is it going to fix inflation? This is how you know he's bullshitting. And he finally lands back to the transitory crap. Powell said still expects inflation to come down in the second half of this year. Last year was later this year. Then inflation kept going higher and higher and higher. Then it's going to be Q1 2022. And inflation continues to go higher and higher and higher. Now he says the second half of the year, and you watch, inflation will continue to move higher and higher and higher. And then it's going to be 2023, 2024, to infinity and beyond. Inflation is the new normal. What's wrong with inflation? Just live with it. Then Powell says, unexpected inflation surge not caused by the new policy framework. You see how the psychopath moves from the economy's great, but we have a little problem that is getting out of control. It's called inflation, but I'm going to stop it from being entrenched. But inflation is going to be transitory anyways. And if it's not my fault. So whose fault is it, Mr. Powell? Here it is. Russia, Ukraine, you guessed it. Yep, just use that as a scapegoat for everything. The administration say this is Putin inflation. Powell says inflation was supposed to be transitory. I was right. But then came Russia, Ukraine. What a load of crap. You think we're children, right? We're a bunch of dummies. Maybe we are. We have a lot of sheep around, so why not? Anyways, Powell says recession risks not particularly elevated. Hey buddy, your colleagues, the people you work for at Goldman Sachs, just upped the recession possibility. But Powell says, recession is not particularly elevated. It's not a risk. This is the same guy who told you inflation will be transitory. Joker Powell also said, and this is perhaps what stocks liked, he said, I will be looking at evolving conditions, meaning if the stock market goes down another 20%, I might bring back the Coke. So continue to buy stocks right now. The Fed put is still alive. Now, what about the balance sheet, Mr. Powell? The balance sheet, excellent, he says. Excellent progress. We're working on that. Next question, please. Well, what if things get out of control, Mr. Powell? What if inflation continues to move higher? What if the Russia-Ukraine situation gets a little worse? And God forbid, people start blaming you for inflation. Biden realizes that the Putin price hikes is not landing, and he turns against you and throw you under the bus. Well, Powell says if that's the case, if it is appropriate to move more quickly, I will do so. And this is bearish. But for now, market participants did not care about that. There is a tunnel vision for now that has been building before the FOMC meeting and the conference by Powell. And that tunnel vision is buy the oversold stocks, the technology, the software stocks, and dump the winners. And then we'll digest and start shitting our pants again. You have your boy Bullard from St. Louis. He's not happy with what happened today. He wants 50 basis points increase. So that could happen in the next meeting. If, say, inflation doesn't cool down even after the 25 basis point hike, then we'll try 50. If 50 doesn't work, how about 75? How about a full point? How about we crash the whole thing? But rest assured, the recession risk is not particularly elevated right now. Trust us. So what do you do with all of this information? Bro, I get it. You've been talking about Ukraine, the Fed, Russia, China. Who cares? Just give me the ticker, tell me what to buy, what to sell, and let's move on. Hold your horses, because fund managers, the sentiment among fund managers is changing. Last month, the majority of fund managers were not expecting a bear market. This month, the majority are expecting a bear market. On top of that, the headline reads, top investors dump stocks. Why, that might mean you should buy. I think this was written by Tom Lee. So the top investors are dumping and the dumb money should buy? What is this? What is this garbage? But guess what? The dumb money's buying. And they might be right this time around, at least for a little while. Retail traders have been more aggressive buyers of the recent dip in the stock market than any other correction since the 2008 crisis. This is according to Bank of America. The bank said that retail investors have been particularly aggressive group of buyers of the most recent dip. Retail clients have bought equities every week year to date. Wow. Whoops. Talk about catching a falling knife. Or excuse me, knives. But hey, as the saying goes, even a broken clock. So anyways, there have been more aggressive buyers than any of the 10% plus corrections in the post-crisis era. So a lot of dip buying, and you got the blessings of Tom Lee, you got the blessings of Marco Kralanovic, JP Morgan, who's sticking to his bullish outlook yet again. He's been saying buy the dip, buy the dip, buy the dip since October. And so far it has been pie in the face, pie in the face, pie in the face, pie in the face. But at some point, we're gonna run out of pies. But here's the problem, Kralanovic and J. Powell. Look at the past episodes when the Fed was tightening. We're looking at the 2-year yield rise. The most destructive episode was in 1999 because that tightening cycle destroyed the dot-com bubble, ended the dot-com mania. We are now, so far, surpassing the aggressiveness of 1999 when it comes to tightening cycles because the 2-year yield has been absolutely exploding higher and we haven't even had the hike yet. The Fed didn't even increase interest rates, at least until today. So that tells you that this will be an aggressive cycle of tightening and the destruction will be extremely severe. So yes, we could have technical rebounds, oversold rallies, bear market rallies, but make no mistake about it, everything will fade away again and we will see more pain in this market. So what do we do from this point on? You can look at the losers, meaning the oversold stocks. I'll give you some names here just to illustrate for you why these stocks popped significantly higher today. But here's the problem, folks, with bear markets. These massive bear market rallies, they're impulsive, they're powerful, they can produce double-digit gains in a single day, but they don't last for too long. So you might be seduced by a move today of certain stocks blasting higher 5, 6, 7, 9, 10, certain cases over 30% today alone. But will that hold? Not according to the history of bear markets. So it could last another day, another week or so, but sooner or later, we're going to resume the same theme that has been going on year to date. But in a bear market, when you have oversold conditions of the RSI and the momentum indicators, any good news, just like we got today, even if it's not really good news, any excuse, I should say, we see these massive pops higher. For example, I'll give you some names. How about Autodesk? This is a weekly chart. Look at the RSI. I want you to look at the RSI. Oversold, waiting and waiting for any good news to pop higher. Today was the day we got a massive pop for Autodesk. Another name, Alibaba, a daily chart. It got severely oversold. And again, any hint of good news will force tremendous short covering, and hence you get the massive rally that we got today in the name. Is it going to last? The assumption is maybe for another day, another week, but sooner or later, these stocks, which are in bear market territory, will have these bounces and then they will resume the pain ahead. Another one, BLK, BlackRock, a weekly chart, way oversold in the RSI. Today was the day when the good news, quote unquote, came out, and here we go, a massive bounce for BlackRock. Another one, CRM, Salesforce, a weekly chart, oversold in the RSI. Any good news will pop the stock higher in a bear market rally. JP Morgan, a daily chart, way oversold in the RSI. Any good news, any movement in the 10-year yield higher, and you see the stock blasting like we saw today. Another one, MCD, McDonald's, a daily chart. It has been in a free fall, but again, it got really oversold, technically speaking, on the RSI. Any hint of good news, and you see right away the bear market rally, the oversold rally working out, producing impressive gains. Either you catch these or you're going to miss them out because they're not going to last for too long. And the risk is you jump in the wagon a little too late and you eat a pie in the face. Here's another one. The ticker ROKU, Roku, a weekly chart. Way oversold in the RSI. And it is bouncing higher today based on the good news that we got. And the assumption is this bear market rally in Roku could last for more days, perhaps a few more weeks, and it will produce sizable gains. It produced double-digit gains today alone. So let's say tomorrow we get another 5, 6, 7, 8% in Roku. Now we're talking about 20% gains in a couple of days. And therefore, you fix those oversold conditions quickly and the bear market fades away. This is the risk with these names. Here's another chart. The ticker SNOW for Snowflake. And this is a daily chart. It got really oversold and hence the oversold bounce, the bear market bounce, whatever you want to call it. Is it going to last? For a little while, for sure, but sooner or later, the best case scenario for this chart is consolidation, because this is how bear market charts trade. They have these massive bounces and then they flush down again, or once they find a bottom, they consolidate and trade in a boring manner for weeks, if not months and years, before they start moving higher again. But I think the risk here is we have certain market participants who believe in the fantasy that some of these charts will trade back to all-time highs. It's not going to happen. It's going to take months, not years, for some of these charts to reclaim the all-time highs. Another one, Spotify, the ticker SPOT, weekly chart, got really oversold in the RSI. Today was the day for the bounce. Here's another one, the ticker WING, Wingstop. This is a daily chart. It got really oversold in the RSI. And today was the day for the rebound. And lastly, what about Zoom, ZM? Way oversold on the weekly chart. Today was the day for the bounce, and Zoom scored big. But all in all, the chart remains in bear market territory. More losses will come, and the best case scenario is consolidation for a long, long time before we see new highs again, in a process that could take years. Just look at some of the dot-com darlings, Intel, Microsoft, Cisco. Some of these names took over 20 years years before reclaiming the highs from 1999. Now, let's talk about the winners. And year to date, we have certain winners. I happen to like these stocks, and they've been performing tremendously, beating this bear market. These are some of the names, my picks at least. We have Berkshire Hathaway, Freeport-McMoRan, Lockheed Martin, ADM, Archer Daniels, Mosaic, Nutrien, ZIM, this is for marine shipping, Deere, Union Pacific, Alcoa, Chevron, Occidental, Marathon, Hershey's, Canadian Railway, AbbVie, Barrick Gold, Kroger. All of these names are winners year to date in a market that is down big from the top. Let's look at some of these charts and see what's going on. We start with the ticker AA Alcoa daily chart. This one got a little overbought, and it is working out these overbought conditions in the RSI and other technical indicators. Another one, AbbVie, the ticker ABBV, a weekly chart, has yet to pull back, but it is just a matter of time before we see profit taking in this name too. Here's another one, ADM, Archer Daniels, a daily chart. Look at the MACD, look at the RSI, overbought both ways. Sooner or later, this chart will pull back, working out all of these overbought conditions. We see some profit taking, perhaps some rotations here and there, but winners and winners. The strong is strong for a reason. And the reason is these names have been beating inflation. So sooner or later, you will see money flocking back into these names. Here's another one. KR, Kroger, a daily chart, got way overbought on the RSI and MACD indicators, and now it is working out all of these overbought conditions, technically speaking. Sooner or later, after this chart becomes a little more attractive and we see more profit taking and prices get more reasonable, perhaps all the way back to 52, even 50, you will see buyers buying the dip in this chart because the fundamentals are strong. The company continues to beat inflation. Here's another chart. The ticker LMT Lockheed Martin. It pulled back big today. We have some negative news that we're going to cover in the heat map analysis, but it also pulled back based on the technicals. Look at the RSI indicator. Look at the MACD indicator. All in overbought territory. So we're seeing profit taking in this chart. Sooner or later, the fundamentals remain strong, so sooner or later, they're gonna buy the dip again. Here's another one, Mosaic, MOS, a daily chart, way overbought in the RSI and MACD. It is working out these overbought conditions. The best case scenario is consolidation for a little while until these conditions are worked out, or another pullback perhaps to 52, even 50 before we see dip buyers showing up again. Another chart, NTR, Nutrien, a daily chart. Similar story with Mosaic. It is overbought technically speaking. It is working out these conditions. It did not participate in today's rally. You're seeing profit taking from the winners and buying the dip in losers, at least for now. Here's another one, the ticker OXY, Occidental. This is a daily chart, a massive blast higher, yet the momentum indicators are way overbought. You gotta work out these technicals out of the equation. You gotta have the profit takers taking the profits, and then the chart will become attractive again and it will be bought. So the bottom line is the following. Yes, we're gonna trade some of these oversold bounces, but you gotta do it quickly because they're gonna fade away quickly. So my strategy for now is I'm gonna trade some of these oversold bounces. I'm gonna take profits in some of the names that I happen to own in my portfolio from this list. But sooner or later, the goal from this strategy is to raise cash and buy these names again at a better price because these are the names that have been beating inflation consistently. And so far, the trajectory for inflation is higher and higher and higher. And if that is the case, then we will see the continuation of multiple contraction in the high multiple technology kind of names. But these names will be attractive again once the overbought technicals are worked out, and they will be bought. This is quality versus garbage that is bouncing on mere technicals alone. I keep telling you folks in this channel over and over and over again, you gotta have the mentality of the trader and the mentality of the investor. Two different things. The mentality of the trader right now is we have opportunities in these oversold names. They can continue to rebound for a few more days, if not weeks, and that's a lot of money to be made. On the other hand, the investor mentality says, I gotta invest and buy in quality, in names that are beating inflation, because 25 basis points is not gonna do shit to tackle this inflation. And with that, folks, let's move on to the market information, and we start with how the indices closed today. And here we go! The Dow Industrial Average closed in the green by 518.76 points, or a gain of 1.55%. The Nasdaq leading the pack, gaining 487.93 points, or a gain of 3.77%. The S&P 500 also closing in the green by 95.41 points, or a gain of 2.24%. And here are the sector's performances today. Leading the pack at number 1, capturing the gold medal, cyclicals. At number 2 for the silver, technology. Number 3 for the bronze, communication services. The laggards of the day, utilities, energy, and defensives. Be it all sectors of the market closed in the green. What about the advance to decline ratios? NYSE 80% advancing versus 17% declining. The NASDAQ 80% advancing versus 15% declining. Now, when we see these exaggerated ratios to the upside, you're gonna get a pullback at least in the pre-market session. Moving on to futures, commodities, we have a contrast, a divergence between the WTI and Brent. The WTI closed the day in the green by a little over 1%. Brent, on the other hand, was down almost 2% today. We have a mini rebound for gasoline and heating oil, closing the day with gains of almost 2%. So again, folks, pay attention now. We're going to spend some time digesting what Powell said. And the market, for all you know, could come up with the conclusion and say, wait a minute here, Powell was actually hawkish. And therefore, let's go back to buying oil, wheat, palladium, fertilizers, the defensives, and dump technology again. Because technology already bounced. Certain names bounced double digits today alone. So you got to be careful now making all of these assumptions. Natural gas futures were pretty much flat today. On the other hand, softs, we have a mixed picture. Leading the gains today, the loser for the year, coffee. Coffee led the gains, closing the day with almost 3% in the green. Now, you're seeing the same theme here, even in the commodities market. They're dumping the winners, booking profits from wheat, lumber, crude, and they're buying the laggards. Coffee, OJ, cotton. Speaking of, today we have gains for OJ and cotton. On the other hand, cocoa pretty much in the flat line, while we have losses for lumber, almost 2% in the red, followed by sugar, which was down almost 1%. What about metals? Metals are trading in the green. Gold is up, silver up, platinum, copper, palladium, all in the green. Is the sell-off in palladium over? Again, you combine this with gasoline, with the WTI, and soon enough wheat. Could we see the revival of the Russia-Ukraine trade? This will depend on the fate of the peace talks. But folks, even if we have a peace deal, are we to believe that the Russian sanctions will be just removed just like that? I doubt it. I seriously doubt it. And hence, sooner or later, the trade of crude, gas, palladium, wheat will be revived once again. What about meats? Flattish activities for feeder cattle and lean hogs futures, while we have live cattle futures closing the day in the red, down about 1%. Grains, a flattish day for soybean oil and oats, a modest down day for canola, soybeans, and soybean meal, while we have a lot of pain. Look at that, rough rice. It was a rough day for rough rice, down almost 2%, and then corn, down a little over 3.5%, but wheat, the poster boy for the Russia-Ukraine war, was down by over 7% today. So it's a mixed picture all in all. The market is still in the digestion mode of all of the news that we got today, be it from Russia-Ukraine or the Federal Reserve. Moving on to the options market, the big casino, the hottest table per usual is Apple, with a little over 1 million contracts traded today, but 57% of those were calls. And at number 2, Alibaba, with almost 1 million contracts traded today, about 73% of those were calls. And it was a tsunami of call options buying. We're talking millions and millions of dollars. Massive, giant trades. But here it is, number 3, TSLA, Tesla, the souffle, with a little over 650,000 contracts traded today, about 54% of those were calls. And here are the unusual activities that took place in the options market today. We start with the ticker KWEB, KWEB, the Chinese Technology ETF. This is a big one. They bought the 33 calls for the expiration date April 1st with expectations. The KWEB could move higher by more than 6.5% by then. They paid about $2 a piece to enter this trade, all in all spending about $10 million. What about the ticker BABA for Alibaba? They're betting for more gains to come here. I mean, the name is already up over 30% today. You're kind of stretching it unless we have a tsunami of short covering, but maybe a little Johnny come lately. Anyways, they're buying the 120 calls for the expiration date March 25th with the expectations that the name could continue to move higher by more than 14% by then. They paid about $2.35 apiece to enter this trade, all in all spending about $6 million. What about the trade for the ticker HD Home Depot? They're buying puts, interesting, the 285 puts for the expiration date, May 20th, with the expectations that Home Depot could drop down by more than 14% by then. They paid about $4 apiece to enter this trade, all in all spending about $4 million. Continuing with interesting trades, what about the ticker JD for, you guessed it, JD? They're buying calls, betting for more gains to come. Again, is it Johnny come lately? Who knows? But they're buying the 67.5 calls for the expiration date, May 20th, with the expectations that JD could add an additional 5% or more in gains by the expiration date. They paid around $6 apiece to enter this trade, all in all spending around $3 million. What about the ticker FB for Facebook? They're buying puts, fading the rip right away. The 190 puts for the expiration date, April 8th, with the expectations that the name could drop down by more than 6.5% by then. They paid about $4 apiece to enter this trade, all in all spending about $1.6 million. Lastly, what about the trade for the ticker JPM? JP Morgan. They're fading the rip right away, buying the 130 puts for the expiration date, April 1st, with expectations that the name could drop down by more than 6% by then. They paid about $1.35 apiece to enter this trade, all in all spending about $550,000. Moving on to the heat map analysis, a sea of green across the board. The tide that lifted all boats started with China, then Ukraine, then J. Powell. What are the losers? The losers are the defense contractors, specifically Lockheed. Lockheed was down big. Why? We have some bad news. The Pentagon will request fewer F-35s from Lockheed Martin. In my opinion, that's garbage. Why would the U.S. order less F-35s? We have Poland, Germany, Australia, all of these countries stampeding to buy F-35s. But hey, this will give you a nice dip to buy LMT. Give it a little more time, and then stocks like this that are beating inflation with solid fundamentals and tailwinds will continue to be bought. Among the underperformers today were also the agricultural names, Mosaic, Nutrien, Corteva, all down. We also have oil and gas down, Exxon, Chevron, the high beta names, along with the winners for the year in defensives, ADM and KR, Kroger, also down. So again, profit taking in the winners, even in the big pharma names, AbbVie, J&J, Bristol Myers, and then buying the dip via algorithms, short covering, options, and some legitimate retail dip buying in technology and the oversold names. Moving on to the heat map for the ETFs. Again, a sea of green. And what are the laggards? The laggards are the winners year to date. We're talking about XLP for staples. We have the XLU for utilities. All the energy ETFs, the XOP, XLE, OIH, lagging for today. The inverse indices, that goes without saying. The VIX proxies are down, but gold is also lagging. One of the winners year to date. Growth outperforming value by a lot, both in the green, but look at the IWF versus the IWD, VUG, versus the VTV in value. Growth is outperforming tremendously. What about international markets? Obviously, the Chinese names rebounding the most, but it is a sea of green across the board. Do you really think that this picture will last? That this is sustainable? Of course not. But it is rebound day, the tide that lifts all boats, and then we'll do the digestion and we'll sort it out. Moving on to charts, and we start with the SPY, the S&P 500 30 minutes chart. A gap higher in the morning. The chart started to look overbought in the RSI from a 30 minutes perspective, and I told you, any disappointment in the chart will flush down right away, and this is exactly what happened. The chart struggled to break above 434, and then it gave up, and it went all the way down, losing 430 as support, but closing the gap in the morning. And then what happened? Jerome Powell opened his hole, and we saw the rebound. And the chart managed to recapture 430 and 434 as support, closing at the highs of the day. Is the action, technically speaking, bullish or bearish? The answer is it is super bullish. Why? Because number one, the chart retested 430 multiple times. It failed once, but it managed to recapture the important line of 430 as support. And now it has a cushion in 434, even if we have a down day tomorrow. Number two, the chart went down to close the gap, and it managed to rebound higher, closing at the highs of the day. You cannot find anything that is bearish in this behavior. And hence, if we have a change of mind tomorrow and we see the bulls getting served pies in the face, it will be indeed a bull trap, because all indicators At least technically speaking, we're pointing out for more gains to come for the SPY. And here's a daily chart for the continuous contract for the SPY. What do we see here? A massive rebound higher. We're now above 4,232. And on top of that, the chart is trading above the sloping line of resistance. The volume spiked higher on the buying side for the second day in a row. The momentum indicators are curling their way higher. All of these are solid indicators that the bulls are winning. The bulls found their footing. The selling already dried out, and now the bulls are turning the table and taking charge of this chart. And we're now eyeing 4,384.5 as resistance. And if that is broken, then the next resistance will be around 4,418.75. But mind you, and I don't mean to speak with both sides of the mouth, but I've been teaching you this in this channel over and over and over again. Once you have a sloping line of resistance broken, usually, not always, but usually, in typical charting behavior, the chart goes back to revisit the same line, retesting it as support before it bounces higher again. So after 2 days of an impulsive rally, it is reasonable to say that before the end of the week, we will see some profit taking and the chart could go down to revisit the sloping line now of support, not resistance, and then we'll take it from there. So you have to be aware of all of these levels, resistance, support, so you can be prepared for any and each scenario. What about the Qs, the Nasdaq 30 minutes chart? Again, a gap higher, and it became overbought in the RSI, and I tweeted about it today, and right away when the hawkish talk came out from the FOMC minutes, the chart went down right away, flushing down, losing the support of 334. Then came Powell with the rescue, and the chart managed to recapture 334 once again as support. It did not make it all the way to 343, but again, we're not going to make a big deal out of it. The challenge for the Qs right now, can it close above 343 from the weekly closing perspective or not? Perhaps it is asking too much, but that will seal the deal that we have a bottom for now that we can work with for at least a few weeks. Moving on to the daily chart for the continuous contract for the Nasdaq, a massive rebound higher. The chart now recaptured 13,300 as support, 13,599 as support, and on top of that, it is now battling 14,000 as the next resistance. The volume spiked higher on the buying side. The momentum indicators are curling their way higher. All of these are good signs that the bulls are taking charge of this chart once again. Can the bears make a comeback? Yes, they can. How would they make a comeback? If there is the digestion part of what Powell says, and the market realizes, wait a minute here, this is too bearish. We made a lot of progress in terms of working out the oversold conditions in a lot of charts in a short amount of time. But here's the weekly chart perspective. If we zoom out, you can see clearly the yellow trend line that acted as support this time around. It has been resistance and it has been support. And so far, the trend is still intact as support. Can the Qs initiate a rally from this point on? If that is the case, then the bulls will be emboldened and we will see a lot of cash that is waiting on the sidelines being poured, and the Nasdaq can initiate a rally for weeks, if not months. The problem is, the moment the chart starts to give back the gains from the bounce, and the moment the trend line is broken, the bears will be emboldened and we will see another shorting opportunity in another flush down in this chart. Moving on to the IWM, the Russell 2000 30 minutes chart. A massive gap higher, and by now you know the story. It got a little overbought. Then came the disappointment from the FOMC minutes, and the chart went down. To where, by the way? To 196.5. It retested that as support. It did not close the gap, by the way, but it retested 196.5, and it decided it is time to blast higher off the heels of Powell's commentary. But all in all, folks, the chart has been trading within a range. 191.5, 204.5. Absent of closing the week above 204.5, you're not going to feel comfortable and out of the woods yet in the chart of the IWM. Moving on to the Dixie, the dollar, a daily chart. Finally, we have Jerome Powell with whatever bird you want to use to describe his comments, bearish, hawkish, it doesn't matter. For now, the dollar thinks that Jerome Powell was slightly dovish because we have a negative divergence on the RSI. The technicals were overextended to begin with, and we were waiting and waiting for any dovish commentary by Powell for this chart to move down. And if the dollar moves down, where is the opportunity, by the way? The answer is international markets, but specifically emerging and developed markets. But you got to keep in mind that this is tricky Dixie after all. If it wanted to flush down, and I'm just reading the chart psychologically speaking for you, if it wanted to flush down, it could have went down all the way to 97. Why was the drop muted in the dollar index. It tells me that there is a process of digestion, that perhaps we could have seen a knee-jerk reaction today, and the confirmation that it is not a knee-jerk reaction would be the dollar closing the week below 97. But if the dollar pops higher again, and it is a possibility, by the way, then we will see a lot of pies being served. What about gold? Gold is starting to find a bottom here, starting to find a footing, and it is battling the Fibonacci used to be support, now resistance at around 1,910. Is it time to buy gold? It is certainly better than a few days ago when gold dipped to 2,000. And a lot of folks bought the dip at 2,000. Now you have the opportunity to buy gold at around 1,900. The tailwinds, the fundamentals remain intact for gold. So yes, I did buy the dip in gold, specifically in the miners that I own. Moving on to the 10-year yield, the chart of the day. It went up, it went down, but it closed in the green all in all. Now comes the digestion part. Was Powell hawkish? Was he dovish? And what does that mean for the yield curve all in all? Because if he's going to increase interest rates by another 625 basis points, and that is the minimum, by the way, all in all 7 times this year, then this will dip the economy into a recession, meaning the 10-year yield at some point will yield less than the 5-year, and at some point less than the 2-year. So at some point, this chart will also plateau and start to move to the downside. And my bet is, after the digestion, at least for now, we will see a pullback all the way to at least 1.94. And if that happens, we will see a pop higher in the TLT. This is a weekly chart. And the TLT will close the gap at around 134.5. Because believe it or not, after the digestion, a lot of folks will hear Powell and say, you know what, he was actually a little more hawkish than we expected. And if we have any frizzling out of the peace talks between Russia and Ukraine, you could see the TLT blasting higher, not just recapturing 134.5, but even giving it another shot at 140. But the weekly closing is important. Is it going to be above 134.5 or below? A closing above means that I could be right. We will see the TLT rallying for a little while. A closing below will throw that theory out of the window. Moving on to the VIX 4-hour chart, we now have a confirmation of the weakness in the VIX. Look at the MACD indicator. It failed to cross. We're still seeing red impressions in the histogram. We had a rejection with a confirmation now at around 33. So SPY bulls are emboldened right now. So far, so good. The assumption for now is the VIX will continue to go down and the SPY will continue to move higher. Until what? Until we see a bottom in the VIX. Look at the chart. Where is the next support? We know it is 20. That is the solid support, but there are a lot of support lines in between. And the most important one is at around 25. So watch out for the VIX. We could see another drop, let's say tomorrow, in the VIX, and the SPY opens gapping higher. If that is the case, then I'm going to be watching this chart, the VIX, and how it reacts at around 25. Moving on to the VXN, the VIX for the NASDAQ 4-hour chart. Again, we have a confirmation now. We're seeing red impressions in the histogram, meaning that the assumption for now is VXN down, NASDAQ higher. If that wasn't enough, look at the pattern. It was higher lows. Today was broken. We have a lower low. So we have to look for a bottom, the next support. And for now, the assumption is that 27.5 is that next support. So again, similar story with SPY. If we see a gap higher tomorrow again, I'll be watching the Qs, I'll be watching the VXN and how it reacts at around 27.5. Moving on to Apple, a lot of progress today. Apple managed to crack above 157. It is now support, and now it is eyeing the upper border of the channel to retest as resistance. The volume moved higher on an upside day. The momentum indicators are curling their way higher. All of these are good indicators that Apple could rally for a day or two, all the way till the next resistance. But what if we have another pie in the face kind of day? Then you couldn't have seen it from the technicals alone. It is due to the psychology. Serving the pies was due to the psychology, not the technicals, because the technicals right now are improving dramatically, not just in Apple, but in the Qs as a whole. Here it is, another chart, Tesla, TSLA. This is an hourly chart. It is comfortably above the sloping line of resistance, now support, and the next resistance the chart is eyeing is around 866.14. We have plenty of resistance before that, but it is soft resistance, not a hard one. If we get to 866, for example, the chart will become overbought if it happens in one shot, and then we will start talking about the opportunity of perhaps buying puts, betting on a pullback. What about tulips, BTC, Bitcoin? Today was higher than average volume on the buying side. The chart made it all the way to 42,000. It did not break above 42,000. It pulled back by a little bit, but we'll give it another day and see if we have a break above 42,000. But most importantly, the three amigos, and better yet, if we have another day with higher than average volume on the buying side. All of these would be good indicators that perhaps it is the time to buy BTC and the worst is behind us. We're out of the woods. But absent of that, still watching, still observing, not participating in this one. And lastly, what about AMC? An hourly chart. A beautiful recapture of 14.24, and the chart retested that level of support, and it held, and we saw a rebound higher. This is a fantastic development for AMC that perhaps we have a bottom for now that we can play with. The assumption is, if this pattern holds, we have more gains to come for AMC. Absent if this entire day was just a mere knee-jerk reaction, and we will see pies being served tomorrow. Absent of that, if today was not a knee-jerk reaction, then AMC should continue to move higher. Moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the initial jobless claims, building permits, housing starts, the Philly Fed Manufacturing Survey, this will be important, then we have the Industrial Production Index, and lastly, the Capacity Utilization Rate. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.